In this video, I'm going to try to shed some light on one of the things that I have found over the years confuses students, okay? And it's what I'm calling here one big reason why sometimes accounting seems so difficult, and it deals with the cutoffs and periods. So let's first look at some assumptions here. U.S. GAAP relies on the assumption that an economic entity, that's a business, right, is a going concern, meaning that it will exist for a long time. So keep in mind, this is an assumption that we think that any business we're doing accounting for is going to continue for a long time. And furthermore, that it will report financial results on a periodic basis. So in other words, it's going to report financial information in shorter periods than the full life of that company and under the accrual method. All right, so the accrual method, just to kind of recap, it involves recognizing revenues when you earn them, right? The key is when you earn them. In other words, if you're providing a service or if you're selling a product, it's when you do the service or when you actually deliver that product, right? And that at that point you recognize that revenue. And you also have to recognize the expenses when incurred, and these revenues and expenses go on your income statement. So let me illustrate, or let me contrast what this idea of a full life could be like versus these shorter periods that we're discussing here. If we didn't have these cutoffs, right, we would have a company's full life depicted right here. This could be from the beginning of 1 year until the end of many years further down the road. Okay, so in this case, let's just say that a company exists for 3 units. This could be a decade, this could be a year, it doesn't matter, okay? But this company exists for a long time, and if we did not have cutoffs, okay, if we did not have to cut on, normally it's on a yearly basis, but if we didn't have to cut companies into years, if we would just describe a company from the beginning, that from when it started until when it was closed, then you would have one set of financial statements. That's it. At the end, you would have a balance sheet, which would give your ending balances of assets, liabilities, and owner's equity. And then you would have an income statement that would give you the revenues earned throughout this whole period, minus the expenses incurred throughout that whole period. Whether that's 3 years, 3 decades, 300 years, it doesn't matter. Okay? But you would have one set of financial statements and they would be done at the end. And given that, that would really simplify life, okay? Because you would not have to worry about these cutoffs that I'm talking about and I'm depicting here in different colors. Okay, so because we do have to report on a periodic basis, then we split a company's full life into blocks. And these blocks could be a year, right? Most likely. So these shorter periods, here, let's call this one X1, let's call this one X2 and X3. And because of that, we have to prepare balance sheets with ending balances as of this particular date, but let's call this 12/31 X1. We have to report the ending balances for the assets, liabilities, and owner's equity. And we have to recognize the revenues earned during this period minus the expenses incurred during that same period, and that gives us net income for that period, right? Contrast that with doing this only once, when you would just have a full life period be the one that you recognize the revenues for. But no, we have to do it in small blocks, right? So allow me to illustrate how this idea of the cutoffs creates complications that sometimes students mess up on. So let's look at a few examples here. Simple ones. Consider unearned revenues. Okay, so unearned revenues is when your customers, give me 1 second here. Unearned revenues is when your customers give you money in advance for a service that you're going to provide in the future, right? If we were under this idea that a company has just one period, a full life, then I could very easily just debit cash for the amount of money received ahead of time and credit revenue. even though I have not done the service yet, provided the service yet. And the reason I can do that is because I know that I'm going to do an income statement only at the end of this period. So at the end of this period, somewhere along that one period of life of this company, somewhere along this line, I will have earned it because I'll provide the service. So it's not incorrect for me to just jot it down as revenue here. And then somewhere along the way, I do the service and that's it. And then when my income statement gets prepared at the end of the whole life, then revenues will be accurate because there's only one reporting period. Okay? Now, we know that we can't do that. So the way we currently do it is we say, okay, if I get money ahead of time, $100 from a customer, I have to recognize it as a liability, unearned revenue, in the period in which I get the money, and then in the period where I actually provide the service. Let's say this is the future here, X2. If I provide the service in X2, then that's the year in which I can recognize the revenue. And let me not say year, that's the period in which I can recognize the revenue. So this liability here serves as a place to put this idea that I still owe this service to the customer. And eventually, when I do provide that service to the customer, I reduce that liability and I say, okay, there's the revenue. But notice how this allowed me to shift the revenue recognition from period X1 to period X2. And this is correct because when I prepare the income statement right here, I want to recognize the revenues earned during this period. And in X1, technically, if this is the only transaction, which obviously is not realistic, but if this is the only transaction, I would have zero revenues in my income statement because I earned zero revenues, even though I got money ahead of time, right? Okay, so this is what we do simply because we have these cutoffs. So sometimes students get mixed up because, okay, now we got to create a liability here and then it reverses out later on. But don't lose sight of why we're doing it. Okay, this is how easy it would be if we have a company that just reports once in its life. This is the regime we live in, okay? So because of that, we have to shift revenues to the periods when they're earned. Let me give you another example. I'm going to go through a few examples just so you see some of the topics that you already know and you can see why we do these kind of things. All right, so here's the other one. Dealing with bad receivables. So you sold something on account, and then you have a bad receivable in the future. Okay, so we sold something on account, accounts receivable here, and revenue is recognized. And I can recognize the revenue because I sold the item. Now, this could be one customer, it could be several customers, it doesn't matter. Somewhere in the future, okay, when I'm trying to collect my $100, I collect everything but $15. In other words, I collect $85 on account, but some customer never pays me. So somewhere in the future, I have to make the decision that I have to write off that accounts receivable. And when I write it off, I'm going to expense it. And if I am only doing one set of financial statements for the whole life of this company, this is correct. There's no problem with doing this. Because my whole life will be revenues of $100 minus expense of $15, and they will be right here. It will account for all of them. But once again, that's not what we do, right? We have several periods that we gotta periodically report on. So on X1, when I sell this, when I recognize this revenue right here, I need to also recognize the expense for what I think will go bad in the future. And this is a tough one, right? Because at this point, this is where we introduce estimates and we have to use a lot of assumptions. So I really don't know how, at the end of X1, I really don't know how much of these receivables is going to go bad. But if I make an estimate, okay, and I estimate somewhere around $15, it could be a little bit higher, it could be a little bit lower, it doesn't matter. But if I estimate that the expense will be around $15, then when I create my income statement, I will be matching the revenues and expenses of the same periods because I have a cutoff right here. Now, keep in mind, at the end of X1, I really don't know who it is, so I cannot credit accounts receivable. Hence, why we use allowance for uncollectible accounts. Now, as the future comes, I find out who it is, right? Which customer is the one I'm going to write off? So at that point, I take out the accounts receivable and I bring in this AFUA. In other words, I created this amount so that I can reverse it in the future once I know who I'm writing off. And notice what we do with this. By doing this, we accomplish something very important, that on this income statement, we're going to have the fact that we have revenues of 100 minus some calculation of expense around 15 bucks. That's on the income statement. On the balance sheet, we're going to have accounts receivable of 100 minus a FUA of around $15. So this allows us to not only report revenues and expenses matched for the same period, but it also gives us the potential to report accounts receivable at a net realizable value, some estimate of net realizable value. Hence, not overstating assets, right? All right, let's go to another example. So I'm going to do a few here. Bear with me. So imagine you're dealing with notes with interest, right? So you sell something to a customer with a note, and interest is going to be paid by that customer to you in the future. So here's the note receivable, here's the revenue. Perfect. In the future, you get $110, which includes $10 of interest. And I'm not worried, let's not worry about the calculation, the percentages, any of that. It's just 10 bucks, I'm telling you. Again, this is not a problem if you're in a world where you're doing the accounting once in your life for the whole life of the company. But that's not the case, right? We know that we have to separate interest earned during those different periods. And that's what this down here reflects. So you have the same transaction here, notes receivable. But at the end of the year X1, I'm going to have to recognize some of that revenue, interest revenue. And since it's $10 overall, it's going to be $5 in X1 and $5 in X2. Just to keep it simple, okay? So here, I'm not getting those $5 yet, but I have to account for the fact that this is a receivable. These $5 are also going to be collected in the future. So given that, I can recognize some revenue in that period, and hence my income statement will reflect not only the revenue from the sale, but also revenue from the loan that I issued to somebody. And it's in the same correct period. Now, later on, when I actually get the money, it'll still be $110 that I get from the customer. But notice how now I'm crediting note receivable for 105, the summation of these two. And I'm only recognizing interest revenue of $5 in X2. Okay, so by doing that, I'm shifting the revenues in the right periods, 5 for X2 and 5 for X1. We don't live under this environment here where we could just do one accounting for the whole life of the company. No, we live in an environment where we're periodically reporting revenues earned, expenses incurred, right? So because of that, this is why we do these kind of things. Let's look at the flip side. What if I have a notes payable instead of a notes receivable? So if I have a note payable, in other words, I borrow some money, let's say, with interest paid in the future. Okay, so in this case, I get cash, it's a liability. Later on, I pay, so I have interest expense of $10. Again, that's fine if we have a whole life reporting environment, but we don't. So I need to recognize the expenses in the periods that are incurred. So here I borrow the money, and then at the end of X1, I need to recognize part of the expense incurred for interest. And I am not paying it right now because that is due at the end of X2, let's say. But at the same time, I have to recognize that I have a liability of $5. So anybody looking at financial statements as of this cutoff will see that we have expenses incurred of $5, and we also have more liability. And that's important information for financial statement users. Then at the end of the next period, when we actually have to pay 110, we will reduce the liability of 105, which is the summation of this, and then we only recognize $5 of interest expense. Okay? A lot of the things that we do, these adjustments that we're constantly doing, it's because we have these cutoffs, and you have to appreciate, even though there's a little bit of extra work, you have to appreciate what it allows us to do. It allows us to recognize the revenues and expenses correct for each period. And that's very important. And by you recognizing those revenues and expenses that are correct, you're also getting ending balances for assets and liabilities that are correct. All right. Let's look at another example. I just have 2 or 3 more examples here. So assume, here, let's space this out a little bit so it's not so busy. So assume, let's look at an example of long-lived assets. Assume you purchase property, plant, and equipment on 1/1/X1 to be used for 2 years. If you're under an environment where the company just reports once, then when you buy this machine, you could technically just expense it. Depreciation expense, you could just do it right away. And then credit cash. And the reason you could do that is because you're going to prepare financial statements over here. So who cares whether I recognize the expense here or here or here? It doesn't matter. It's all one period. And with the financial statements being reported at the end of the life. Okay, but again, obviously that's not where we stand. So the way we do it is, when we buy this asset, we recognize it as an asset, as property, plant, equipment. And then we distribute that expense to the periods in which we benefit from that asset. So at the end, if it's 2 years that I say right here, then at the end of X1, we're going to do depreciation expense and then credit accumulated depreciation. This will allow us to show that on the income statement that we have an expense of $50. And also it will allow us to show on the balance sheet that we have property, plant, and equipment with a book value of 50. In other words, 100 is the historical cost minus its accumulated depreciation of 50 at the end. So you'll see property, plant, equipment, book value also 50. And that's important information. X2 comes around, well, we'll depreciate it again. And this way we are able to allocate those expenses in the periods in which they belong. Because recall, I'm preparing financial statements right here. I'm also preparing financial statements right here. So because of that, I need to make sure that this periodic allocation occurs correctly. Just a little twist right here. What if I purchase this and I put it to use not on 1/1/X1, but at the middle of the year in X1, on 7/1/X1? If that's the case, this will be July 1st. So I buy the asset, I capitalize it. I'm still using it for 2 years. I'm going to put in here to be used 2 years. But now, even though it's 2 years, it's going to be 6 months in X1, a full year in X2, and it's going to be 6 months in X3. So that gives us the 2-year period of usage. So at the end of X1, I'm going to depreciate 1/4, right? 25, because if a full year is 50, half a year is 25. And let's not worry about the depreciation method I'm using or anything. Let's just keep it real simple. We're trying to see how we distribute these expenses. If I use the asset the whole X2, well, it gets a full year depreciation of $50. And then in X3, I'm going to get a depreciation of $25 halfway through the year right here, when I use the remaining 6 months right there. Okay? What have we accomplished? We have successfully, through this system of allocation, we have successfully recognized the expenses in the period that benefited from that asset. And that's real important if you're preparing financial statements right here, and then at the end of this period. And I know it seems a little exaggerated to keep repeating this idea that if the company only reported once, that it wouldn't matter. Because if you prepare financial statements at the end right here, your depreciation expense is still $100 for the whole period, right? Look at what happens when I do it for each separate period. This is depreciation expense 25, 50, and 25. That's still $100. So the day I prepare financial statements over here, even though I'm reflecting only $25 expense for X3, do keep in mind that I already did 75 in the previous 2 years. So that's why, this can be done, because you're only going to do that journal entry once. You're only going to do that financial statement once. But again, this is not the world we live in, right? This is not the rules. All right, let's see a couple more ideas here. Contingent liabilities. Okay, so contingent liabilities are these potential liabilities that may arise if certain negative things happen. So what's an example? An example is if you're being sued, you're in litigation for something that your company potentially did. So you're being sued in court, and at the end of X1, we believe that it's probable. And when the probability of a contingent liability is probable, then we need to recognize it, right? But at the end of X1, we believe it's probable that we will lose. That's just a belief, right? Okay. Under a whole life idea of a company, I don't care. I'm not going to recognize anything anywhere early until I lose the case. So let's say that somewhere in the middle of X2, and by the way, if you're thinking whole life, it doesn't really matter whether that's X2, X1, it doesn't matter. It's just part of one life. So somewhere along part of one life, I know that sounds weird, I lose the case. I'm told you have to pay $100, and that's it. You have no choice. So at that particular date, I'm going to recognize the loss and pay the cash. And that would be not a problem because I'm only preparing financial statements once in my life right here. Now, reality is we can't do that. If I know at the end of X1 that it's probable that I'm going to lose this case, then at that point I need to recognize that loss as of that period because that's an expense incurred in X1. So even though I may not know exactly how much it is, I can estimate and say, well, it's around $100. So there's my loss. It'll go on the income statement. And here's my estimated liability that will go on my balance sheet. So anybody that picks up financial statements as of this point will understand that there's a potential payout to be done in the near future. Now, later on, when we actually are told we lose the case, the judge says we got to pay. So here we reduce that liability we created and then we credit cash. Now notice what we did. Through the use of this liability account, we were able to shift the recognition of the loss or the expense in the period in which we determined we incurred it. Okay? I think I have one more example and that's it. Oh no, a couple more examples, sorry. Let's do this one here. Okay, so income tax deferrals. So when you know that we have revenues and expenses that are recognized under GAAP, under the accrual basis, but then you have revenues and expenses, or sometimes referred to as deductions, that are recognized for tax purposes under the Internal Revenue Code. So there's two different standards that are being followed, for one for financial reporting for GAAP and another one for tax reporting or tax compliance, which is the Internal Revenue Code. Given that you sometimes have timing differences, the accounting doesn't always work the same. So let me give you an example. Here's some revenue that you earned on account. In other words, you provided services, meaning you can recognize revenue for GAAP purposes, but you still have not received the cash. So if you have not received the cash, you don't recognize that revenue for tax purposes. Okay? So what that does is that you could just say, well, if the taxable income, so let me note what I have here. Net income, according to this description, net income is higher than taxable income because I'm recognizing revenue for stuff that I don't have the cash for. So my net income recognizes that revenue, so it's $30. And my taxable income is lower because I still have not received that cash, so I don't recognize this for tax purposes. Given that you have differences between net income and taxable income, right? Or more technically, this is pre-tax income. But just so you understand that it's GAAP income. So if my tax rate is 30%, then all I have to do is send a check to the IRS for $3. $10 times 3%, and that's $3. So under a whole life idea, I do that. I just go in here, debit tax expense, and credit cash for $3. Now, afterwards, later on, when I actually get the cash from these customers, then that becomes that is included in taxable income. Those revenues are now included in taxable income. But I'm not going to double count them for net income for GAAP purposes. I already did it once. So later on, when I get this money, then it goes on the tax return, let's say, and I'm going to have $20, that difference. I get the $20 times 30%, that's $6. So I would have a tax expense of $6, and I would pay the IRS cash of $6, which is 20 times 30%. That's okay for financial reporting purposes if you only had one whole life idea. But that's not how it works, because if you notice, for a whole life idea, you have tax expense of $9 throughout the whole life. But the problem is that if you're breaking a company down into periods, then that whole $9 is shifted in the wrong periods here. Because if my net income is $30, then my tax expense for financial reporting purposes is $30 times 30%, which is $9. In other words, this tax expense is the expense incurred for GAAP purposes. Let me repeat that. This tax expense is the expense incurred for GAAP purposes, for financial reporting purposes. So I have to jot down the whole $9 because for GAAP purposes, I recognize the full $30, including revenues for which monies I have not received. So for financial reporting purposes, I do have a $9 tax expense. Now, I'm only going to pay the IRS $3, just like we calculated up here. So how do we account for that difference? We use a deferred tax liability. And notice how this deferred tax liability is used to shift that payment of $6 in the future without having to recognize the expense in the future. So yes, for tax purposes, I collect the monies from customers. So once I collect the monies from customers in the next period, then I have more taxable income, $20 more. So I'll have to pay the IRS $20 times 30%, which is $6. But keep in mind, the revenue for GAAP purposes was already recognized, so the tax expense for GAAP purposes should have been recognized in a previous period, not in X2. All right? So something like a deferred tax liability sometimes confuses students as in terms of why we use it. Well, we use it so that we can have our GAAP tax expense correct in the period in which we assign it. All right. And obviously, I just mentioned this, but I'll say it again. If we had one financial reporting period the whole life, then it wouldn't matter. We could just do this because if it's one whole period, that one whole period has a tax expense of $9. It doesn't matter. Even if most of it came over here, it doesn't matter because we're reporting it as one whole unit. But the moment you start reporting those periods, small amounts, those smaller periods, then you need to make sure that the tax expense for that period is the one you recognize. And that's why that happens. Okay, this is the last one here. I think you are getting the idea of how important cutoffs are for us and how it complicates things, okay? It makes things a little bit more complicated. Hopefully you're appreciating that right now. The last one I'll do is when a company has investments, they need to be marked to market, okay? Certain investments, not all, just to be clear. And what this means is when you refer to something as being marked to market, it means that you have to carry it at fair market value. So you have to constantly be updating the value of that asset, that investment. This could refer to investments classified as trading securities or available for sale. So those would be carried at fair market value, mark to market. There's other items too. If you choose the fair value option, you do that. So you carry this investment at fair market value with changes recognized as gains and losses. And to be more specific, those changes are recognized as unrealized gains and losses. But let's keep it simple. So on January 1st or the first day of existence of this company, you buy this investment. Here's your investment, $100. You bought stock in another company. You bought some shares in some company, and this is how you record it. Then later on, many years later, or many periods later, you sell it. And the investment when you sell it is worth 120. So you sell it for 120, you reduce the investment, and you have a gain of $20. Great. If your company does financial statements once in the whole life, this is perfect. There's no problem with this. But if you report in periods, shorter periods, like here, then that would not work. So here you would have the investment at $100, and then at the end of the year, you would have to assess what the fair market value of that investment is, and you would have to mark it to market, to fair market value. So at that point, the investment, let's say that it's worth 104, right? At the end of X1, you would increase the value of investment of 4, and you would recognize that gain of 4. Later on, we move on. At the end of X2, that same asset, that same investment, that same stock that you invested in maybe, is worth 107. So here it was worth 104, and then here is worth 107. Okay, so I'm going to recognize $3 more, so investment goes up and gain goes up by $3. This gain of 4 goes on the income statement ending right here, so it'll reflect a gain of 4. Your investment on the balance sheet will reflect 104, and then at the end of X2, when you prepare financial statements, you'll have a gain of 3, and your investment on the balance sheet will reflect a balance of 107. Now, at the end of year X3, when you sell it, we said it was worth 120. Great. Your investment comes out at 107, which is the carrying value of it, and now the gain is 13 for X3. So what you have done is you have appropriately allocated that gain to the periods in which it corresponded. At the end, this is still $20 gain, right? 4 plus 3 plus 13, that's $20 gain. But it's in the allocated periods. All right? So, yes, this would work if the company was just one period, but it is not. So that's why we have to do all these little crazy little things throughout the accounting system that I just described. And this is just a few examples, obviously, but I wanted you to appreciate the fact that we assume under GAAP that companies report on a periodic basis, shorter periods than the full life. And because of that, we have all these quirky things that we do. Okay, hopefully this helps you in seeing why we do all these adjustments at the end of the period, these accruals, these deferrals.